Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. Cryptocurrency hodling strategies. Now that you've done your pre-hodling homework, it's time to discuss hodling strategies that can help you achieve your investment goals. Use the minimum expected return to choose your cryptocurrencies. After determining your minimum required rate of return, it's time to do a bit more research for hodling cryptocurrencies that have the highest chances for success. In particular, you must research on the average rates of return on your prospective cryptocurrencies, particularly if you plan to buy those that are already being publicly traded. Why? It's because tokens being sold through ICOs don't have past prices to compute average returns with. For illustrative purposes, let's say that after doing your research, you find that the average annual returns on Bitcoin, Ethereum, and Litecoin were 30%, 20%, and 25%, respectively. If your minimum required rate of return is 18%, which of the three would you choose? Chances are, you'd go for Bitcoin without batting an eyelash because it has the highest average annual return at 30%. I wouldn't say it's wrong, but what I can say is that it's incomplete. Why? When comparing actual returns to average returns, they are rarely the same. Actual returns aren't equal to the average, but they tend to be within the range of the computed average in most cases. This means that actual returns can be higher or lower than the computed average by up to a certain amount. To optimize your chances of being able to achieve your minimum required rate of return, you'll need to choose investments whose most conservative estimated or forecasted future returns equal or exceed your minimum. And for this, you'll need to compute for the standard deviation, which measures the volatility of returns or how far can you reasonably expect returns for a specific investment to be from the mean or average return computed. Allow me to illustrate this in a way that you can easily understand. Let's say that the computed standard deviation for Bitcoin, Ethereum, and Litecoin were 15%, 3%, and 7%, respectively. What do these figures mean? It means that you can reasonably, not perfectly, expect the return for Bitcoin this year to range from 15%, 30%, 15% to 45%, 30% plus 15%, where 15% is the lowest expected return for Bitcoin for next year. For Ethereum, the annual return for this year to range from 17%, 20%, 3% to 23%, 20% plus 3%, and for Litecoin from 18%, 25%, 7% to 32%, 25% plus 7%. Now, compare the lowest expected returns for each of the three cryptocurrencies. Bitcoin's is 15%, Ethereum's is 17%, and Litecoin's is 18%. Given your minimum required rate of return, the wise choice would be Litecoin because its lowest expected annual return for this year is the only one that satisfies your 18% minimum requirement. Without the benefit of standard deviation, you could have gone for Bitcoin, which has a reasonable chance of registering a lower annual return than your required minimum. And even though its mean or average annual returns the highest, it's also the most volatile with the highest standard deviation, which resulted in the lowest among the low end of the expected return spectrums. Diversify. A very crucial hodling strategy that you can apply to practically any financial investments. It means to spread your investment eggs in different baskets so that if one investment basket drops, your other investment eggs won't crack. And more than just investing in at least two cryptocurrencies, you must also make sure that you don't put all your investable funds in cryptocurrencies only. Why? Because Bitcoin, Ether, Litecoin, and other altcoins belong to the same class of financial assets, which is cryptocurrency. There's a good chance that when something happens that concerns or can affect the whole cryptocurrency industry, the prices of all your cryptocurrencies may simultaneously take serious hits. For example, if the Federal Reserve makes a pronouncement that will make it more difficult to transfer funds from banks to cryptocurrency exchanges, it won't just be the price of your Bitcoin that will go down. But if you also diversify your investments to other financial assets, you reduce the potential impact of negative events on your total portfolio. Cost averaging. This is a very useful hodling strategy that can help you earn good returns despite substantial price drops in the cryptocurrencies in your portfolio. So how does cost averaging work? Cost averaging refers to a method of investing by which you buy more units of a financial asset, cryptocurrencies, bonds, stocks, etc., when prices go down. You may be thinking, why the heck would I buy more units of a financial asset whose prices are going down? That's a good question, one that I'm inclined to answer. The principle behind cost averaging is this: by buying more units of a financial asset when its price goes down, you bring down your average initial cost per unit of that financial asset. So what's the significance of this? If your average cost goes down, your break-even price for that financial asset goes down as well. That means you don't have to wait for the price of that financial asset to fully recover just to break even. And if the price eventually goes back to the same one at which you originally bought it, you won't just break even but make a profit already. Allow me to illustrate with a practical example. If you bought one Bitcoin at $10,000 and its price plunges to $6,000 afterwards, you would have suffered a $4,000 or 40% loss on your investment. For you to break even, the price of Bitcoin has to fully recover back to $10,000. And for you to make a profit, you'll have to wait until Bitcoin goes above $10,000 per unit. Now let's see what can happen if you employ the cost averaging strategy. Say you bought another unit of Bitcoin when its price dropped to $6,000. Now, you have two Bitcoins for a total investment of $16,000, $10,000 plus $6,000. By using simple averaging, your average cost of buying per unit of Bitcoin is $8,000, $16,000 divided by 2 Bitcoins. Now, you only need to wait until the price of Bitcoin goes up to $8,000 to break even, compared to waiting for the price to go back up to $10,000 to break even when you only owned one unit of Bitcoin. And when it goes back up to $10,000 per Bitcoin, you would have made a profit of $2,000 per Bitcoin, or a total of $4,000 for your total investment. If you didn't cost average, you'd have to wait until the price of Bitcoin had gone up to $14,000 per Bitcoin just to register a $4,000 profit. Conclusion: there's no denying that the next frontier in the evolution of the world's financial systems is Bitcoin and other major altcoins like Ethereum, Litecoin, Ripple, and Monero. As such, good quality ICOs also have a bright future in the world of digital finance. But being able to successfully hodl and take advantage of the opportunities that cryptocurrencies, both existing and those that'll be issued in the future, require smart work and a whole lot of self-discipline. To the extent you can work smart and control yourself, especially your emotions, is the extent you can successfully make money by hodling Bitcoin and other cryptocurrencies. To recap, hodling refers to holding or keeping cryptocurrencies, and that this word is a mistyped version of the word hold, which has grown to be an accepted term in the cryptocurrency community. Hodl is also a long-term approach to investing, which can also be called as a buy and hold approach. To successfully hodl, there are 2 phases you need to get right: the pre-hodl phase and the actual hodling phase. The pre-hodl phase is when you prepare for taking positions in cryptocurrencies by knowing your investment goals or purposes, establishing your minimum acceptable rate of return, estimating the amount of risk you can take, and reading the damn white papers of ICOs, if you're looking to buy new tokens or coins. The actual hodling phase involves choosing the optimal cryptocurrency based on the minimum expected range of returns, diversification, and cost averaging. I have always been fascinated with this modern-day financial system. I believe that anyone who has invested her time and money in this book is one part interested in this new form of encrypted exchange, one part skeptic, uncertain and dubious about this concept. There is nothing wrong with showing doubt and being a little negative about something that we do not know. I know I was negative once. Terms like bitcoins, ICOs, blockchains, cryptocurrencies, whatnot, they are all new for us, and we have every right to know about their history, workability, advantages, and anything in between. Thus, in this book, I am going to get you acquainted with cryptocurrency terminology, as well as give you a brief explanation of how it operates and pays an investor. Does it have any potential? Yes, it does, but certain aspects make it follow a discrete environment. Firstly, let us understand how we can define cryptocurrency. A cryptocurrency is defined as an asset fabricated to operate as a way of exchange carried out digitally. It implements a protective technology known as cryptography, which regulates the generation of more credit units and monitors their transfer between parties. Simply put, cryptocurrencies are a form of currency in the digital world that do not follow the rules and regulations of a centralized banking system. Transactions work through a decentralized database called blockchain, which we will examine in detail in later chapters. Bitcoin, which emerged as the first cryptocurrency in 2009, has gained worldwide fame over the years. It was Satoshi Nakamoto, a pseudonym used by an individual or a group, who developed Bitcoin as the first cryptocurrency. Also, they were the ones to fabricate the beginning of a blockchain database. Since then, numerous decentralized cryptocurrencies have revamped the operations of the traditional financial system. Bitcoins and alternate cryptocurrencies, also known as altcoins, are already witnessing tremendous growth, making them a part of new technology in the financial world. With the digital era evolving to new levels, Bitcoins and other cryptocurrencies are likely to grow exponentially in the future. With benefits that offer multi-operational utility in the financial sectors, cryptocurrencies are developing an open system that will allow us to exchange credits in ways that no one thought possible. Thus, it is even more significant that you learn about this digital phenomenon and familiarize yourself with how it works to secure your financial assets.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye-bye.